As of June 5, 2026, there were 40,706,667 shares of the registrant's common stock outstanding. Mama's Creations Inc., together with its subsidiaries, the company, formerly known as Mama Mancini's Holdings Inc. and Mascot Properties Inc., was organized on July 22, 2009 as a Nevada corporation. The company has a fiscal year end of January 31. Our subsidiary, Mama Mancini's Inc., Mama Mancini's, is a marketer, manufacturer, and distributor of meatballs with sauce, grilled, roasted, and breaded chicken, sausage and peppers, and other similar meats and sauces. In addition, the company continues to diversify its product line by introducing new products such as ready-to-heat meals, single-portion pasta and rice bowls, bulk deli, and packaged refrigerated protein products. Mama Mancini's products feature many all-natural meals that were submitted to the United States Department of Agriculture, the USDA, and approved as all-natural. The USDA defines all-natural as a product that contains no artificial ingredients, coloring ingredients, or chemical preservatives and is minimally processed. Our subsidiary, TNL Acquisition Corp., is a premier gourmet food manufacturer based in New York. TNL Acquisition Corp. does business as TNL Creative Salads, TNL, and Olive Branch, AW, and offers a full line of foods for retail food chains and club stores, delis, bagel stores, caterers, and provision distributors. Our Creative Salads brand uses high-quality meats, seafood, and vegetables prepared to meet the standards set forth by the USDA and the Food and Drug Administration, OFANWES. Our Olive Branch brand concentrates on selling olives, olive mixes, and savory products to large retail customers, primarily in prepackaged containers. Our subsidiary, Crown One Foods, Inc., Crown, based in New York, is a full-service food manufacturer of value-added proteins and premium ready-to-heat meals. Crown focuses on claims-driven protein solutions, including distinctive cuts. Crown also is USDA and Safe Quality Food (CCREAF) certified and specializes in artisanal vegetable and grain sides and center plate offerings in bulk as well as single-serve solutions. The company considers all highly liquid instruments purchased with an original maturity of 3 months or less to be cash equivalents. The majority of the company's cash and cash equivalents are held at one financial institution, which at April 30th, 2026, exceeded insured amounts by approximately $23.1 million. The company believes it mitigates such risk by having the cash and cash equivalents held by a major financial institution. Accounts receivable are stated at the amount management expects to collect from outstanding balances. The company generally does not require collateral to support customer receivables. Estimated product returns are immaterial. Management assesses the collectability of outstanding customer invoices and maintains an allowance resulting from the expected non-collection of customer receivables. In estimating this allowance for credit losses, management considers factors such as historical collection experience, customer creditworthiness, specific customer risk, and current and expected general economic conditions. Customer balances are written off after all collection efforts are exhausted. The accounts receivable and allowance for credit losses were approximately $13.4 million and $0.2 million, respectively, as of April 30th, 2026, as compared to $13.3 million and $0.2 million, respectively, as of January 31st, 2026, and $8.2 million and $0.1 million, respectively, as of February 1st, 2025. During the 3 months ended April 30th, 2026 and April 30th, 2025, the company did not write off any accounts deemed uncollectible. The company values its inventory at the lower of cost or net realizable value, (UNRV). NRV is defined as estimated selling price less costs of completion, disposal, and transportation. The cost of inventory is determined on the first-in, first-out basis. The cost of finished goods inventories includes ingredients, direct labor, freight in for ingredients, and indirect production and overhead costs. The company monitors its inventory to identify excess or obsolete items on hand. The company reviews inventory quantities on hand and records a provision for excess and obsolete inventory based primarily on selling prices, indications from customers based upon current price negotiations, and purchase orders. In addition, and as necessary, specific reserves for future known or anticipated events may be established. As of April 30th, 2026, and January 31, 2026, the reserve for obsolete inventory was approximately $133,000 and $135,000, respectively. Property, plant, and equipment are recorded at cost, net of accumulated depreciation. Depreciation expense is computed using the straight-line method over the estimated useful lives of the assets. Upon sale or retirement of property and equipment, the related cost and accumulated depreciation are removed from the accounts, and any gain or loss is reflected in the condensed consolidated statements of operations. The company reviews the recoverability of property, plant, and equipment when circumstances indicate that the carrying value of an asset or asset class may not be recoverable. Indicators of impairment could include, among other factors, significant changes in the business environment, the planned closure of a facility, or deterioration in operating cash flows. Considerable management judgment is necessary to evaluate the impact of operating changes and to estimate future cash flows. Expenditures for repairs and maintenance that do not substantially improve or extend the useful life of an asset are expensed as incurred. Goodwill represents the excess of the purchase price over the fair values of the underlying net assets of an acquired business. The company tests goodwill for impairment on an annual basis during the fourth quarter of its fiscal year, or immediately if conditions indicate that an impairment could exist. The company evaluates qualitative factors to determine if it is more likely than not that the fair value is less than the carrying value, and whether it is necessary to perform goodwill impairment testing. As of April 30, 2026 and April 30, 2025, there were no impairment losses recognized for goodwill. Fair value is an exit price, representing the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. As such, fair value is a market-based measurement that should be determined based on assumptions that market participants would use in pricing an asset or liability. The carrying values of the company's short-term financial instruments, such as cash and cash equivalents, accounts receivable, and accounts payable, approximate fair value due to the immediate or short-term maturity of these instruments. The interest rate on the company's line of credit and notes payable has a variable component which is reflective of the market for such instruments at any given date, and as such, the carrying value of the debt approximates its fair value. Level 1. Observable inputs such as quoted prices in active markets. Level 2. Inputs other than quoted prices in active markets that are either directly or indirectly observable. And Level 3. Unobservable inputs for which little or no market data exists, therefore requiring the company to develop its own assumptions. Financial assets and liabilities are classified based on the lowest level of input that is significant to the fair value measurement. Research and development is expensed as incurred. Research and development expenses were $87,000 for the 3 months ended April 30, 2026, compared to $73,000 for the 3 months ended April 30, 2025. The company's sales are primarily generated from the sale of finished products to customers. Revenue is recognized when the performance obligation is satisfied and the promised goods have been transferred. Control transfers when the product is shipped or delivered, based upon applicable shipping terms. For each contract, the company considers the transfer of product to be the performance obligation. Although some payment terms may be extended, generally, the company's payment terms are approximately 10 to 30 days. Accordingly, there are no significant financing components to consider when determining the transaction price. The company elected to treat shipping and handling activities as fulfillment activities, and the related costs are recorded as selling expenses in selling, general, and administrative expenses on the condensed consolidated statements of operations. The company promotes its products with trade incentives and promotions. These programs include discounts, slotting fees, coupons, rebates, in-store display incentives, and volume-based incentives. The trade incentives and promotions are recorded as a reduction to the transaction price, based on amounts estimated as being due to customers at the end of the period. The company derives these estimates based on historical experience. The company does not receive a distinct service in relation to the trade incentives and promotions. The company's contracts are all short-term in nature. Therefore, there are no unsatisfied performance obligations requiring disclosure as of April 30, 2026 and January 31, 2026. Costs of sales represents costs directly related to the production and manufacturing of the company's products. Costs incurred for producing and communicating advertising for the company are charged to operations as incurred and are included in selling, general, and administrative expenses. Advertising expenses were $761,000 for the 3 months ended April 30th, 2026, compared to $814,000 for the 3 months ended April 30th, 2025. The company provides compensation benefits in the form of performance stock units, restricted stock units, stock options, and warrants. The cost of the stock-based compensation is recorded at fair value on the date of grant and expensed in the condensed consolidated statements of operations over the requisite service period. The company has granted performance awards in the form of performance stock units, PSUs, to certain employees. Each PSU award entitles the participant to earn shares of common stock upon the attainment of certain market conditions and/or certain performance goals over the applicable performance period. The recognition of the compensation expense for the performance stock awards is based upon the probable outcome of the market condition and/or performance conditions and is based on the fair value of the award on the date of grant. To determine the value of PSUs with market conditions for stock-based compensation purposes, the company used a Monte Carlo simulation valuation model. Forfeitures are recognized when they occur. The company's performance against the defined goals is re-evaluated on a quarterly basis throughout the performance period, and the recognition of the compensation expense is adjusted for subsequent changes in the estimated or actual outcome. The company values stock options and warrants using the Black-Scholes option pricing model. Grants of stock-based payment awards issued to non-employees for services rendered have been recorded at the fair value of the stock-based payment, which is the more readily determinable value. The grants are amortized on a straight-line basis over the requisite service period, which is generally the vesting period. If an award is granted, but vesting does not occur, any previously recognized compensation cost is reversed in the period related to the termination of service. The company has granted restricted stock units, RSUs, that entitle the participant to earn shares of common stock as long as they continuously provide service to the company through a given date. The company values RSUs by multiplying the number of underlying shares of common stock by the closing stock price on the date of the grant, and the related expense is recognized ratably over the vesting period of the awards. If an award is granted, but vesting does not occur, any previously recognized compensation cost is reversed in the period related to the termination of service. Basic net income per share attributable to common stockholders excludes dilution and is computed by dividing net income during the period by the weighted average number of common shares outstanding during the period. Diluted net income per share reflects potential dilution and is computed by dividing net income attributable to common stockholders by the weighted average number of common shares outstanding during the period, which is increased by the number of additional common shares that would have been outstanding if the potential common shares had been issued. However, if the effect of any additional securities is anti-dilutive, i.e., resulting in a higher net income per share or lower net loss per share, they are excluded from the dilutive net income computation. The dilutive effect of stock options, warrants, and restricted stock is calculated using the treasury stock method. As of April 30th, 2026, the company has approximately 1.6 million performance share units outstanding that are contingently issuable upon achievement of specific performance targets. Because the performance conditions were not met as of the reporting date, these shares were excluded from the calculation of diluted net income per common share. Current income taxes are recognized for the estimated taxes payable or refundable for the current fiscal period and are based on the taxable income for the current fiscal period, including adjustments for unrealized tax benefits, changes in tax receivables, payables that arose in a prior period, and recovery of taxes paid in a prior period. Current taxes are measured using tax rates and laws enacted during the period within which the taxable income arose. Current tax assets and liabilities are offset only if the right of offset exists. Deferred income taxes are recognized for the future tax consequences of temporary differences between the carrying amounts of assets and liabilities for financial reporting purposes and their respective tax basis. Deferred taxes are measured using enacted tax rates expected to apply in the years in which those temporary differences are expected to be recovered or settled. The effect of a change in tax rates on the deferred tax assets and liabilities is recognized in provision for income taxes on the consolidated statements of operations in the period that includes the enactment date. Depreciation expense was approximately $1.2 million for the 3 months ended April 30th, 2026, compared to $554,000 for the 3 months ended April 30th, 2025. Amortization expense was approximately $429 for the 3 months ended April 30th, 2026, compared to $370,000 for the 3 months ended April 30th, 2025. Note 6. Related party transactions. Upon consummation of the acquisition of the TNL Creative Salads business in December 2021, the company executed a $3 million promissory note with the sellers, which consist of Anthony Morello Jr., president of Creative Salads and Olive Branch, as well as individuals related to Mr. Morello. The promissory note requires annual principal payments of $750,000 payable on each anniversary of the closing, together with accrued interest at a rate of 3.5%, 3.5% per annum. As of April 30th and January 31st, 2026, there was no outstanding balance under the note. Interest expense related to this note was approximately zero for the 3 months ended April 30th, 2026, compared to $7,000 for the 3 months ended April 30th, 2025. On June 28, 2023, the company completed the acquisition of 100% of Chef Inspirational Foods, LLC, in accordance with the terms of the Membership Interest Purchase Agreement dated June 28, 2023, by and among the company, Siegel Suffolk Family, LLC, and R&I Loeb Family, LLC, the sellers, for approximately $3.7 million, including approximately $1 million in cash at closing, and a $2.7 million promissory note, the CIF acquisition. The promissory note required a principal payment of $1.2 million in cash on the first anniversary of the closing date, which was made during the year ended January 31st, 2025, and a payment of $1.5 million in common stock of the company on the second anniversary of the closing date, which was made during the year ended January 31st, 2026. As of April 30th, 2026, and January 31st, 2026, there was no balance outstanding on this note. The company leases 20,188 square feet in a fully contained facility in Farmingdale, New York, from 148 Allen Boulevard, LLC, for production and distribution of creative salads and olive branch products. 148 Allen Boulevard, LLC, is owned by Mr. Morello and various individuals related to Mr. Morello. This lease term is through November 30th, 2031, with the option to extend the lease for 2 additional 10-year terms with base rent of approximately $20,000 per month through December 31, 2026, increasing after that date to approximately $24,000 per month through the end of the initial lease term. The exercise of optional renewal is uncertain and therefore excluded from the calculation of the right-of-use asset. Rent expense and other ancillary charges pursuant to the lease was approximately $84,000 for both the 3 months ended April 30th, 2026 and April 30th, 2025. Note 7. Loan and Security Agreements. The company is party to an amended and restated loan and security agreement, the credit agreement, with M&T Bank _M&T, which provides an up to $5.5 million working capital line of credit through a maturity date of November 28, 2028. The principal outstanding, if any, bears interest at a variable rate per annum based on the company's senior funded debt-EBITDA ratio as defined in the credit agreement, established with respect to the company as of the date of any advance under the credit agreement as follows. If the senior funded debt-EBITDA ratio is I greater than 2.25, 3.25 percentage points above the applicable one-day, i.e. overnight, SOFR as defined. I greater than 1.50 but less than 2.25, 2.75 percentage points above the one-day SOFR. IP Doug less than or equal to 1.50, 2.25 percentage points above the one-day SOFR. The facility is supported by a first priority security interest in all of the company's business assets and is further subject to various affirmative and negative financial covenants. The company was in compliance with the covenants as of April 30th, 2026 and January 31st, 2026. All advances under the line of credit are due upon maturity. There were no outstanding balances on the line of credit as of April 30th, 2026 or January 31st, 2026. During the 3 months ended April 30th, 2026 and April 30th, 2025, the company incurred no interest on the working capital line. The company was party to a loan with M&T for an original principal amount of $7.5 million that was originated in December 2021 and subsequently repaid, payable in equal monthly principal installments over a 60-month amortization period, the TNL note. All of the proceeds of the loan were used to fund a portion of the consideration for the acquisition of the Creative Salads and Olive Branch businesses. The outstanding balance under the TNL note accrued interest based on the senior funded debt EBITDA ratio, as defined in the TNL note. The company repaid the TNL note in full during the year ended January 31st, 2026. During the 3 months ended April 30th, 2025, the company incurred interest of approximately $47,000. On October 1st, 2025, the company converted the approximately $5.9 million balance remaining under a non-revolving line of credit with M&T into a promissory note, which is payable in equal monthly principal installments over a 60-month amortization period, the Crown note. All of the proceeds of the initial draw under the non-revolving line of credit were used to fund a portion of the consideration for the acquisition of the Crown One business. The outstanding balance under the Crown note accrues interest based on the senior funded debt EBITDA ratio, as defined in the Crown note, as follows. If the senior funded debt EBITDA ratio is I greater than 2.25, 3.5 percentage point above the applicable variable loan rate, equals greater than 1.50 but less than or equal to 2.25, 3.0 percentage points of the applicable variable loan rate, or if less than or equal to 1.50, 2.5 percentage points above the applicable variable loan rate, provided that in all events the rate shall not be less than the stated percentage point margin over 0%. During the 3 months ended April 30th, 2026, the company incurred interest expense of approximately $85,000 under the Crown note. Note 8. Concentrations. For the 3 months ended April 30th, 2026, one customer accounted for approximately 39% of gross revenue. For the 3 months ended April 30th, 2025, two customers accounted for approximately 36% and 27% of gross revenue, respectively. As of April 30th, 2026, one customer represented approximately 27% of the total gross outstanding receivables. As of January 31st, 2026, two customers represented approximately 35% and 12% of total gross outstanding receivables, respectively. Note 9. Stockholders' equity. Restricted stock units, RSUs, generally vest on a graded basis over 3 to 4 years of service. The terms of the RSUs include vesting provisions based on continued service. During the 3 months ended April 30th, 2026, the company recognized stock-based compensation expense related to restricted stock units of an aggregate of approximately $242,000, compared to approximately $152,000 for the 3 months ended April 30th, 2025. The restricted stock expense was recorded to selling, general, and administrative expenses or costs of sales, depending on the nature of the related recipient's expense on the condensed consolidated statements of operations. As of April 30th, 2026, there was unrecognized stock-based compensation expense of approximately $2.7 million related to future vesting of restricted stock units. The company values stock options using the Black-Scholes option pricing model. The grants are amortized on a straight-line basis over the requisite service period, which is generally the vesting period. If an award is granted but vesting does not occur, any previously recognized compensation cost is reversed in the period related to the termination of service. For the 3 months ended April 30th, 2026, the company recognized stock-based compensation expense related to options of approximately $19,000 compared to approximately $22,000 for the 3 months ended April 30th, 2025. The stock-based compensation expense related to the options is included in selling, general, and administrative expenses on the accompanying condensed consolidated statements of operations. At April 30th, 2026, there was unrecognized stock-based compensation expense related to the issuance of options of approximately $90,000. A. The outstanding PSUs for which the vesting period has not ended as of April 30th, 2026, at the maximum award level. During the 3 months ended April 30th, 2026, the company granted to its chief executive officer PSUs with a target payout of 68,600 shares of common stock. The PSU award is eligible to vest and settle into between 50% and 150% of the target shares based on the company's actual performance against threshold, target, and maximum adjusted EBITDA. The PSUs had a target value of approximately $1 million. No outstanding PSUs vested in the 3 months ended April 30th, 2026. During the 3 months ended April 30th, 2026, the company recognized stock-based compensation expense related to PSUs of approximately $320,000, compared to approximately $131,000 for the 3 months ended April 30th, 2025. The stock-based compensation expense related to the PSUs is included in selling, general, and administrative expenses on the accompanying condensed consolidated statements of operations. During the 3 months ended April 30th, 2026, the company issued 7,200 shares of common stock of the company, valued at approximately $105,000 for employee compensation. Note 10. Commitments and contingencies. Litigation, claims, and assessments. From time to time, the company may become involved in various lawsuits and legal proceedings that arise in the ordinary course of business. Litigation is subject to inherent uncertainties, and an adverse result in these or other matters may arise from time to time that may harm its business. Licensing and royalty agreements. On March 1st, 2010, the company was assigned a development and license agreement dated January 1st, 29, with Daniel Dougherty, the license agreement. Under the terms of the license agreement, the royalty rate payable by the company is 6% of net sales up to $500,000 of net sales, as defined in the agreement, for each year under the license agreement, 4% of net sales from $500,000 up to $2.5 million of net sales for each year under the license agreement, 2% of net sales from $2.5 million up to $20 million of net sales for each year under the license agreement, and 1% of net sales in excess of $20 million of net sales for each year under the license agreement. In order to continue exclusivity, the company must pay a minimum royalty of $125,000 each year. The company incurred approximately $300,000 of royalty expenses for the 3 months ended April 30th, 2026, compared to $357,000 for the 3 months ended April 30th, 2025. Royalty expenses are included in selling, general, and administrative expenses on the condensed consolidated statements of operations. Purchase commitments. In January 2026, the company entered into 1-year purchase commitments to buy between approximately 14.5 million and approximately 16.6 million pounds of chicken to be delivered in equal weekly installments at agreed-upon pricing formulas. We recognize liabilities for contingencies and commitments when a loss is probable and estimable. No such liability was recognized for these arrangements during the period. The company accounts for leases in accordance with ASC 842, Leases, NYSC 842. We determine whether an arrangement is a lease at inception. This determination generally depends on whether the arrangement conveys the right to control the use of an identified fixed asset explicitly or implicitly for a period of time in exchange for consideration. We have operating leases for offices and other facilities used for our operations. We also have finance leases relating primarily to machinery and equipment. Our leases have remaining lease terms of approximately 1.2 years to 5.6 years. Note 12. Income tax provision. The company's effective tax rate for the 3 months ended April 30th, 2026 was 21.9%. Differences from the statutory rate primarily relate to state taxes. As of April 30th, 2026 and January 31, 2026, the net deferred tax liability was approximately $530,000 and $813,000, respectively. In assessing the realization of deferred tax assets, management considers whether it is more likely than not that some portion or all of the deferred tax assets will not be realized. The ultimate realization of deferred tax assets is dependent upon future generation of taxable income during the periods in which temporary differences representing net future deductible amounts become deductible. Management considers the scheduled reversal of deferred tax liabilities, projected future taxable income, and tax planning strategies in making this assessment. There was no valuation allowance on the company's deferred tax assets as of April 30th, 2026, or January 31, 2026. On July 4, 2025, the One Big Beautiful Bill Act, OBBBA, was signed into law, extending key provisions of the 2017 Tax Cuts and Jobs Act, including, but not limited to, the restoration of 100% bonus depreciation, the introduction of new Section 174A, permitting immediate expensing of domestic research and experimental expenditures, modifications to Section 163J, interest expense limitations, and the expansion of Section 162M, aggregation requirements. The company is currently assessing the impact of the OBBBA, and an estimate of the impact on the company's condensed consolidated financial statements is not yet available. Note 13, Segment Information. For the 3 months ended April 30th, 2026 and April 30th, 2025, the company was managed as a single operating segment. The Chief Executive Officer, who is also the company's Chief Operating Decision Maker, COD-EDM, reviews financial information on an aggregate basis for purposes of allocating resources and assessing financial performance, as well as for making strategic operational decisions and managing the organization. As such, the company has one reportable segment. Additionally, all of the company's assets are maintained in the United States. Additionally, all compartmentificazioni as align with the information that is regularly provided to the Chief Operating Decision Maker. This category contains commission expenses, royalty expenses, and freight-related expenses. Mama's Creations, Inc. is a leading marketer, manufacturer, and distributor of fresh deli-prepared foods, found in over 12,000 grocery, mass, club, and convenience stores nationally. The company's broad product portfolio, born from Mama Mancini's rich history in Italian foods, now consists of a variety of high-quality, fresh, clean, and easy-to-prepare foods to address the needs of both our consumers and retailers. Our vision is to become a one-stop-shop deli solutions platform, leveraging vertical integration and a diverse family of brands to offer a wide array of prepared foods to meet the changing demands of the modern consumer. We continue to monitor commodity costs so that we can purchase ingredients, packaging, and other materials required for production. A variety of other factors may impact the cost and availability of raw materials. Although almost all our inputs are sourced domestically and our manufacturing facilities are all in the United States, we continue to expect that recent tariff volatility will have a limited and manageable impact on the company. We address commodity costs primarily through competitive sourcing procedures and manufacturing and overhead cost control. While certain ingredient costs have recently declined, we continue to face higher fuel and freight expenses, as well as rising labor costs, all of which have negatively impacted profitability. The company looks to offset rising costs through increased efficiencies and price increases to our customers. Market dynamics, promotional incentives, or other factors may cause our pricing actions to lag changes in supply and commodity costs. For the 3 months ended April 30th, 2026 and 2025, the company reported net income of approximately $2.1 million and $1.2 million, respectively. The change in net income between the 3 months ended April 30th, 2026 and 2025 is due to the changes in net sales, costs of sales, and operating expenses described below. Net sales. Net sales increased by approximately 50% to $52.85 during the 3 months ended April 30th, 2026, from $35.03 million during the 3 months ended April 30th, 2025. The increase in sales is primarily due to increased velocities of existing items driven by new marketing and trade programs, new customers, and new products associated with product innovation initiatives and the acquisition of the Crown One business in the September 2025. Costs of sales. Costs of sales increased by approximately 55% to $40.3 million, or 76% of net sales, during the 3 months ended April 30th, 2026, from $26.1 million, or 74% of net sales, during the 3 months ended April 30th, 2025. The increase in cost of sales is due to higher sales, partially offset by increased operational efficiencies resulting from increased overhead, labor, and procurement efficiencies. Gross profit margin. The gross profit margin was 24% and 26% of net sales for the 3 months ended April 30th, 2026 and 2025, respectively. The year-over-year margin rate change was primarily driven by increased labor and overhead associated with new product launches. Operating expenses. Operating expenses increased approximately $2.2 million during the 3 months ended April 30th, 2026, as compared to the 3 months ended April 30th, 2025. The change in total operating expenses are primarily attributable to the following. Freight-related expenses increased by approximately $0.6 million, mainly due to increased sales. Payroll and related expenses, inclusive of stock-based compensation, increased by approximately $0.6 million, mainly due to additional employees associated with the acquisition of the Crown One business and variable compensation arrangements. Other operating expenses increased by approximately $0.3 million due to additional software and EDI-related expenses, travel and office expenses. Insurance-related expenses increased by approximately $0.2 million, primarily due to the growth of the company. Professional fees increased by approximately $0.2 million, primarily due to the growth of the company, and commission and royalty expenses increased by approximately $0.2 million due to increased sales. Other expenses net. Other expenses net decreased by approximately $31,000 to $30,000 for the 3 months ended April 30th, 2026, as compared to $61,000 for the 3 months ended April 30th, 2025. The decrease is primarily due to higher interest income, which is due to a higher average cash balance in the current year period. Liquidity and capital resources. We finance our operations with internally generated funds, supplemented by credit arrangements with third parties and potentially capital market financing. As of April 30th, 2026, we had working capital of approximately $27.8 million as compared to working capital of approximately $24.3 million as of January 31, 2026. The increase in working capital is primarily attributable to an increase of cash and cash equivalents of approximately $4.5 million, partially offset by a decrease in inventory of approximately $0.6 million and a decrease in prepaid expenses of approximately $0.3 million. Operating activities. Net cash provided by operating activities for the 3 months ended April 30th, 2026 was approximately $5.0 million, which consisted of net income of approximately $2.1 million, non-cash expenses of approximately $2.3 million, and a net positive change in operating assets and liabilities of approximately $0.6 million. Net cash provided by operating activities for the 3 months ended April 30th, 2025 was approximately $6.0 million, which consisted of net income of approximately $1.2 million, non-cash expenses of approximately $1.3 million, and a net positive change in operating assets and liabilities of approximately $3.5 million. Investing activities. Net cash used in investing activities for the 3 months ended April 30th, 2026 was approximately $0.2 million and consisted of purchases of fixed assets. Net cash used in investing activities for the 3 months ended April 30th, 2025 was approximately $0.5 million and consisted of purchases of fixed assets. Financing activities. Net cash used in financing activities for the 3 months ended April 30th, 2026 was approximately $0.4 million and consisted of $0.3 million of payments on the Crown Note and approximately $0.1 million payments on finance leases. Net cash used in financing activities for the 3 months ended April 30th, 2025 was approximately $0.6 million and consisted of approximately $0.5 million of payments of debt and approximately $0.1 million payments on finance leases. Credit facility and indebtedness. As of April 30th, 2026, we had no borrowings outstanding under the revolving line of credit available under our credit agreement and approximately $5.3 million outstanding under our Crown Note with M&T. The Crown Note has a maturity date of October 1st, 2030. We also have operating leases for offices and other facilities used for our operations, and finance leases comprised primarily of machinery and equipment leases, as discussed in Item 1. Note 7. Liquidity and Capital Requirements Outlook. Although the expected revenue growth and control of expenses leads management to believe that it is probable that the company's cash resources will be sufficient to meet its cash requirements through at least the next 12 months. Based on current and projected levels of operations, the company may require additional funding to finance growth or achieve its strategic objectives. If such financing is required, there can be no assurance that financing will be available in amounts or on terms acceptable to the company, if at all. In the event funding is not available on reasonable terms, the company might be required to change its growth strategy and or seek funding on an alternative basis, but there is no guarantee it will be able to do so. Critical accounting estimates. There have been no material changes to the critical accounting estimates previously described in our Form 10-K for the fiscal year ended January 31st, 2026. As of April 30th, 2026, we evaluated, with the participation of our management, including our Chief Executive Officer and Chief Financial Officer, the effectiveness of our disclosure controls and procedures as defined in Rules 13A-15E and 15D-15E under the Exchange Act. Based on that evaluation, our Chief Executive Officer and Chief Financial Officer concluded that our disclosure controls and procedures were effective at the reasonable assurance level in ensuring that information required to be disclosed by us in the reports that we file or submit under the Exchange Act is recorded, processed, summarized, and reported within the time period specified in the SEC's rules and forms, and is accumulated and communicated to management, including the Chief Executive Officer and Chief Financial Officer, as appropriate to allow timely decisions regarding required disclosure. From time to time, we may be involved in litigation incidental to the conduct of our business. We are currently not involved in any litigation that we believe could have a material effect on our financial condition or results of operations. During the 3 months ended April 30th, 2026, the company did not repurchase any shares of its common stock.